amid growing concerns about economic growth.
Consumer spending was
As
soft.
expected, cut interest rates another quarter point.
We are following breaking news. All three major American stock markets have closed down.
Bitcoin rose 10%.
It even gave the stock market a temporary second wind.
The market reaction, it was kind of nonplussed.
Tariffs going into effect tomorrow.
But the NASDAQ was also...
Investors will be watching closely for more clues about the direction.
It's time to tune out the noise and tune in to great information with a steward's view. Expect valuable economic updates, investing techniques, and planning concepts that move you to be wise and decide well. You'll be equipped and encouraged in a stewardship mindset, managing God's resources 1 week at a time. You can listen to this podcast and previous episodes at astewardsview.com.
Welcome back. I'm Aaron Kolkman. That's Chaz Louder, and this is The Steward's View. I'm so glad you joined us again. Remember to visit this and previous episodes online at astewardsview.com or on your favorite podcast platform. Let's take a look at what happened last week. U.S. equity indexes look set to notch a third straight weekly gain, supported by cooler inflation prints and encouraging developments in U.S.-China trade talks. However, geopolitical risk reemerged as Israel's military strike on Iran Thursday evening sent shockwaves through global markets, driving equity futures sharply lower while oil and gold prices soared. By midday Friday, stocks had clawed back much of the losses, but retaliatory strikes from Iran later in the day left the S&P 500 and NASDAQ composite indices lower for the week by about 0.5%. The Russell 2000 fell 1.5%, while emerging market stocks managed modest gains. Crude oil surged up more than 13.5% on the week, and gold futures jumped 3.6% to $3,450 per ounce. U.S. Treasury yields eased after 10 and 30-year auctions were met with solid demand and inflationary pressures remained mild. The U.S. Consumer Price Index, or CPI, increased just 0.1% in May, putting the annual rate at 2.4%, while producer prices rose 2.6% year over year. Weakness in energy prices contributed to last month's softer readings, but could reverse course due to Mideast tensions flaring. One-year inflation expectations showed a dramatic improvement, falling to 5.1% from 6.6% and helping this month's Consumer Sentiment Index jump by the most since January 2024. U.S. small business confidence also improved in May as trade tensions de-escalated. Turning to international economic news, the World Bank stopped short of forecasting a recession but lowered its global growth forecast for 2025 by 0.4 percentage points to 2.3% for the year. That is its weakest outlook outside of recessions since 2008. The World Bank expects global GDP growth in the coming years to expand at the slowest pace since the 1960s. China's CPI fell for the fourth consecutive month in May, while producer price deflation deepened. Exports to the U.S. plummeted 34.5% year over year, the sharpest drop since February 2020. China's imports also fell as domestic demand remained sluggish. In the UK, economic growth contracted sharply in April after global tariffs and domestic tax increases set in. May's employment figures revealed that British companies are holding back on hiring as job vacancies fell. Wage gains slowed to 5.2%, still above the UK's inflation rate at 3.5%. And finally, investor sentiment in the Eurozone improved this month, boosted by optimism for Germany's new government and fading shocks from U.S. trade policy. What a week we just had. I hear on the domestic front, lower inflation. I hear slowing growth. The word that gets used a lot there is stagflation. So maybe we'll see some of that. In fact, stagflation, to be clear, would require a little bit higher inflation. So the slowing growth part equals stagflation in the minds of some, recession in the minds of others. But again, with that inflation piece remaining relatively low in the U.S., that is, to me at least, an encouragement. And it looks like we've got the same dynamic overseas. So good things there in the inflation front. It looks to me like the labor front is what we'll get to this coming week. So we'll talk about that more towards the end of the segment. But those are my comments. I know the headline has been all about the Middle East conflict. And, you know, my summary to clients on Friday last week was we just really had volatility return. Okay, so the way markets behave when there's things, big headlines like this that are geopolitical in nature, is very reactive. Okay, so we've talked before about the market liking certainty. It doesn't have certainty when two nations are bombing each other in a critical part of the world. Okay, why doesn't it have certainty? Well, those areas of the world and those economies are connected to other economies in other parts of the world. Okay, so whether you're in the Eurozone or you're in the U.S. or you're in China, Japan, whatever, you've got a connection to those economies. And, that's why tariffs come into play as such a globalized picture that we have. No matter how isolated the U.S. policy dynamic is right now, or how protectionist maybe is the better word, we still have this connectedness with foreign countries. And so when these two countries are bombing each other, particularly with the historical picture in the Middle East and all that's wrapped up in this conflict, this exact conflict between Israel and Iran, there's a lot of fear that comes out as well. And so when we see fear spike, we also see, we talk about the VIX or volatility. Volatility spiked dramatically last week, just on Friday afternoon, in fact, by about 20 points if you're a numeric person with that VIX index. So there's a lot that started to happen last week when the markets did not get the certainty that they wanted, right, or that they're used to. I've called the second half of April and May the calm before the storm, not expecting that Iran and Israel would begin to bomb each other. And I'll start with Israel, right, Israel and Iran. But the comment that I'm making is that is a short-term destabilizer, right? And so we don't have the calm that we've had going into the second half of 2025. How does that affect things in the long run? I don't think much. The World Bank readout was, or forecast is a better word, was very muted as to growth in the years ahead. That's an unusual thing for the World Bank to do. They're typically very focused on the current year or just the year ahead. To use the word years that's what's unusual to me. So when I hear a global entity like the World Bank, or I look at the International Monetary Fund, no Chaz, the IMF, not the Impossible Mission Fund, or what is it? Impossible Mission Force.
Yes.
Okay.
Yeah, you beat me to it.
If you watch Mission Impossible, it's not that IMF. It's the other IMF, right? The International Monetary Fund. That and the World Bank, when these global economists, when they come together and they look at things, they tend to look out quarters or maybe a year. They don't tend to talk about years. Okay, so this was a big deal.
Aaron, I sent you a little text over the weekend. I thought you should definitely respond to it because it was a great quote. It was one of the talking head shows over the weekend. This is about a 90% quote. A guy named John Buckingham, he's at Kovitz Principle, said this: "People should be embracing volatility. Volatility is the friend of the buyer for long-term value." And I'm like, ooh, right. That sounds like some risk management. It sounds like up Aaron's alley. We should definitely respond to that.
I'm glad you brought that point. And I just want to mention to listeners, we have a growing listener base here, and I'm so grateful for that. The thing that I really would like to see more of is interaction on podcast platforms. If you want to comment or you want to talk with us or you feel free to visit astewardsview.com or the three major platforms right now that we're on are Spotify, Apple, and Amazon. But Chaz, that comment about volatility and being the friend of the long-term investor, or the creating value. There was something about creating value in that is right up the alley of what we talked about on March 10th, right? Yeah. So interestingly, the slowing growth dynamic that the World Bank just talked about, we talked about on March 3rd. Yeah. Okay? So a lot of this is, to me, not new. Right. It feels new every time there's new digital chaos, headline chaos, I call it. Right. But the underlying fundamentals of the market, I actually came and looked last Friday before I touched a couple of clients and friends of the firm that I manage. And the underlying prices of what investors are paying, we've talked about PEs on this program, what they're paying now and what they're expecting to pay or expected to pay in the future are about the same. Okay. And that just means that the in general terms, the fundamentals of these stocks anyway that we're tracking are very healthy. And what stocks? The S&P 500 companies. This is the U.S. large company index. It's an asset or cap weighted index. So we see a pretty fair valuation in that index, and yet we've got all this volatility. Okay, that is an argument for what you just said, because what we didn't talk about on March 10th, we talked about how to deal with volatility, how to embrace it. We didn't talk about value per se in that conversation. So what's value investing? It's worth revisiting for a moment. We've talked about being invested and experiencing downside price movements in what you own, right? And how you want to come back from that as fast as possible. We haven't talked about buying in at that time necessarily. We've talked about some rebalancing things that are along the same lines, but that is exactly where cash can be. I mean, cash sort of has a double crown on its head in these instances, because, if you you go back into March and April, or first half of April, if you could have deployed cash, particularly early April, the multiples on your cash that you would have gained just in a short amount of time, even to now, is remarkable. I mean, you can have a whole year of gain in a single month. Right. And that's what they're saying. Portfolio manager's talking about. So, it's interesting, isn't it? When we say, okay, well, the S&P 500 is fairly valued, volatility's up, blah, blah, blah. If you look January 1st of any year, let's just use the current year, right? So we expect moderate growth. January 1st to December 31st. We say, oh, well, we have a moderate growth expectation. Okay. So maybe the S&P 500 generates 8%. To me, that's a fair expectation instead of 10. Okay. 10 would be a historical average. So, all right. Well, if the index itself, the composite score number, went up 8%, that doesn't account for you bringing cash in on April 7th or 8th, does it? Right. And so that tracking of when you actually invested, right? That time weighted return is so nice. And so I love those comments, and it's so good to hear that. That's a very reasonable view, by the way, because what they didn't say there was, get in, get out. We can time this. We can, pretend to know what's going to happen next, right? But that's what I hear a lot. I hear, even now at 25 years, I have not stopped hearing so-and-so in the head. I mean, these are authors of books. These are, in some cases, they're doing seminars, programs, and you hear them talk like they may not use the word timing, right? But it pretends that this short-term buck can get made with some degree of accuracy.
Well, let me do a plug for your book, Aaron, because at least high concept. I'm not retaining the information like you, of course, but no. As I read that book, The Life Cycle of Wealth, available on Amazon, as a person who is new to the financial world from working with Aaron, is as someone who just has a macro level, high level concept, I go, well, my goodness, here's the opportunity. But that's more of a day trading, a quick turnaround strategy versus a long-term wealth building. And as I was thinking about your book, you talk more about that as a different strategic discussion versus, like someone just trying to make a quick buck, a quick turnaround type of thing.
It's a great time to deploy cash. Yeah, thank you for the book plug. And but my concern is that, we need to get away from, here again, separating trading and speculation from long-term investing. So even though we're talking about a tactic to deploy new capital or redeploy existing capital, where we've got some volatility to embrace, that still doesn't mean that we're going to get out anytime soon with that piece.
Aaron, I took you down the rabbit hole. We're going to have to go to a break now.
Yeah. Okay. Well, when we come back, let's talk a little bit about asset aggregation and what it is and why it's important. And we can go from there.
More of A Steward's View in just a moment. Investors have stocks, bonds, mutual funds, ETFs, options, futures, real estate, and more. There's one place to look at all of your portfolio. It's called Fusion, Portfolio Aggregation. No contract, no hassles. Fadir's portfolio technology gives its users a chance to see all of their assets all the time, wherever they are. The Fusion platform is open for use without a contract and without a hitch. It's based on mean variance optimization and analysis research by Aaron Kolkman, Fidare uses the Fusion platform to optimize assets for its clients. For more information, visit fidareadvice.com and click on Fusion at the top of the page. That's Fidare Advice, FIDERE advice.com. Now back to A Steward's View with your host, Aaron Kolkman.
And we're back. So, Chaz, as promised, I want to touch on, there's some really big words that get used in this program. And at the very basic level, we talk about having one portfolio, our Fusion program at Fidare Advisors. That's fidareadvice.com. And you go out there and you can click on Fusion and enter in credentials for accounts in a secure way and end up with a single login to all of your accounts. Right. And it doesn't cost anything. We aren't necessarily managing anything for someone that does that. It's a way of viewing
a tool,
all of your assets. Right. But I don't think that we get far enough into the value of it. So I just want to mention that when you're engaged in planning conversations with professionals or with your own family at the dining room table, and you're going through and you're trying to fund goals, what you don't do is say, well, let's just set aside this one invested asset over here, right? The trading account, sure. Okay. Like, by the way, trading isn't all bad. like it's okay to do day trading. Like, there's nothing wrong with day trading. I just want to be clear. But that's not what you fund goals with.
No, I wasn't trying to imply that.
No. But like, I think I give that impression. So I want to clarify. That's just fine and dandy to do day trading, but it's a very different thing. So when you go to fund your goals, and I'm a certified financial planner, and we do the time horizon, and we look at how long it's going to take and the amount of capital required, and how much is available now, and then to be added in the future. Those things, what you wouldn't do is you wouldn't say, well, gee whiz, let's set aside this one capital account over here and not use that to fund our goals, right? Or would you? You might earmark it for a specific goal. That could happen. But you wouldn't say, well, I'm going to take this one capital account I've got, this one invested account, and I'm not going to use it to fund my goals, even though I need it. So you need it, but you're not going to use it. You wouldn't do that, would you?
No, but I want to hear where you're going with this.
Okay.
I do that all the time personally. I'm like, this is my little account for this. I'm setting aside. So I want to hear what you unpack.
Let's just go right for it. So you got a couple 401k accounts, you got an IRA account, you got a trust account, a taxable investment account. However many accounts that was, I think that was 5.
Sure.
Okay. And you're not going to go, well, we've got this $1 million nest egg, and let's say there's 200,000 in each account. Let's just set aside $200,000 and not use it, even though it's needed for our plan.
No, it's insane.
We went talked to our planner, whoever that is.
Right.
Planners, plural, maybe. And, they said, hey, you need this whole $1 million plus this much over this amount of time to do the things that you're talking about. But by the way, you decided not to use 1/5 of your capital. You would never do that.
Right.
Okay. So what Fusion does is it makes sure that you can see all of the accounts in the same place. Okay. Is it in your planning software necessarily? No. But is it as to the investment piece? Is it going to show you a holistic kind of all at once summary of everything? Absolutely. And once you've said, all right, these are the accounts we're going to aggregate or bring together, then you can start to measure all of them together too. Mm-hmm. Right. So what a question I get a lot is, well, what's your return? Hopefully I get the question, what's your risk? Mm-hmm. Okay. Unfortunately, I don't enough. But if I got both questions, I can usually answer it in pretty specific ways. But the issue is that most of the time, without a program like Fusion and Asset Aggregator, you end up with a risk score and a return score for one account at a time. Okay. That's to say nothing of the holdings in all 5 of the accounts in our example. It's only to say that your risk and return scores are separated 5 different ways from each other. And it is, analytical chaos, data chaos. It's nearly impossible to plan with. Okay. So good planners, professional planners like me will solve that for you. What I'm encouraging and what I'm offering is a place to go to solve it for yourself. Mm-hmm. Okay. So especially for the self-directors that listen to this program, and we have a very quickly growing listener base. I'm very glad for that. But you can go out to fideradvice.com and click on Fusion at the top, and you can start to do this where you're going to get a report every quarter. It'll show you risk and reward of all of what you're doing and help you understand, how am I on a longer term trailing, like a 3, a 5, a 10 year, with what I'm actually holding in all of these accounts, coming together to match up with a couple things. My risk profile, like who I am as an investor, is this in line with my expectations? I mean, if I'm expecting a 10% return and, a stock like risk profile of 10 to 15, is that what I have or not? Where's it been? So it's that, and it's also a good double check for when you're with professionals, finance pros, planners, asset managers, whoever, that are saying, okay, well, they may have already given you a proposal. You may or may not have accepted it, but at least you have an idea of what's needed. And we've talked about this too in Funding Your Goals a few weeks ago with total returns, but you've got some idea of what the plan requires, right? So there's two things going on here. There's what the plan requires in terms of just return, by the way, and there's who you are as an investor or investors if you're married. And in those two sets, they're not always the same thing. That's what I want to say. But Fusion will tell you whether or not you're in line with what your plan requires, right? And any advice you may have received, okay? And it'll also tell you if you're in line with who you are as investors, okay? So those are really good reasons to spend, call it 15, 20 minutes, could be a half an hour, pulling together. You take all the logins that you have in your financial life and you register for this tool and you get a login for Fusion, and that becomes a universal login, right? Your other ones don't go away. It's provided by Morningstar, by the way. My firm did not build this, but it's incredibly helpful. So I want to encourage that in future episodes. In fact, I think just next week, we'll go into, once you've done this, whether you use Fusion or something else, once you've done this, what it means to optimize your risk and reward, okay? Because that's a different thing than diversification. So I did not intend for this to be a commercial for one particular tool, but it's the act of aggregating, of pulling together all of your holdings into one place, not just going to the custodian and logging in, how's my statement from last quarter in 5 different places, right? Or getting an investment plan for 5 times over, right? But having one, right? One view, one everything. So it's a different deal.
I'll talk to the missus because you've been after me to actually sign up for Fusion.
That wasn't necessarily towards you.
No. This is good. This is good because you know what? Life is prepped. This is like a tease. Like I'll try to get my wife, because she's the CFO of our relationship. I'll try to get my CFO to sign up for Fusion, and we'll put all of our stuff in there, and then you can analyze it on the podcast.
Oh wow! That you better get her permission for that.
No.
I need to have you guys both sign something.
Yeah,
to
I was
talk
going to
about
say
it,
we could see if there's not like legal implications there.
You can release it. That's fine. You both have to release it though.
Listen,
that's up to you. None of this was designed for you and your better half to go through the program. But I'm trying to articulate the value.
I think that'd be super cool. I'll have to talk to the boss and see if that happens. So maybe we edit this part out.
Maybe just be the guinea pig. Well, yeah. This in truth, many firms have this tool. This is not anything new, right? A lot of places pay for this, but they do it for clients only. Mm-hmm. Okay, so we're doing it in a way that's very open-ended, right? It's just out there as an available option for somebody that wants to come and see what's going on. So, I'm glad we could go over this. There's been a lot of reference to asset aggregation in this Fusion program. Next week, let's talk. So, just backing up for a moment. We've walked through what total return investing is. We've walked through a little bit now today about asset aggregation. We've talked about having a single investment plan across accounts, all of those things. what we're driving at, and we're going to really dive into next week, is consistency investing. Okay. And that's going to be super important, especially in these volatile times, the second half of this year, even. What is today? June 16th through December 31st. Okay. We can start now and understand when I say all 8% or pick a percent, Chaz.
10%.
All 10% returns are not created equally.
Right.
Okay. So let's leave it there. But when we come back next week, let's go into what it means to optimize a return, not just get a return.
Okay.
And that's consistency investing.
That's a good tease.
Okay. So before we wrap up, let's look ahead to next week. A shortened week lies ahead as U.S. markets will be closed Thursday for the Juneteenth holiday. Central banks will garner the spotlight with interest rate decisions due from the U.S., UK, and Japan. The Federal Reserve is widely expected to keep rates steady on Wednesday, despite pressure from the White House to ease monetary policy. Momentum may be building for rate cuts, however, based on recent hard economic data. Last week's inflation readings continued to quell fears that tariffs would quickly cause prices to rise, although the Fed is likely to remind investors that shocks from trade disruptions and geopolitical conflicts present ongoing challenges to taming price increases. The latest monthly employment report, along with weekly jobless claims and continuing claims reaching the highest level since late 2021, are reflective of a slowing labor market. This week's meeting will include an updated summary of economic projections, which should provide insights into how the Fed views the risks of unresolved trade and budget issues, as well as heightening conflicts in the Middle East. The domestic economic calendar includes May's retail sales report, housing data, regional manufacturing survey, and industrial production figures. Overseas, the Bank of Japan is widely expected to keep rates level at tonight's meeting, despite rising inflation. Governor Yuda has been emphasizing uncertainty in recent statements, which could push out the bank's next rate hike further than yen traders had been anticipating. For the Bank of England, weak economic data have raised the odds of further rate cuts this year. However, most experts expect no action this week and don't foresee the next change until September. Last but not least, China's monthly industrial production and retail sales releases round out the international calendar. With that, it's been such a pleasure to be back with you. I hope this session has been a benefit to you and to others you decide to share it with. We invite you to connect with us in your favorite podcast platform or at astewardsview.com. You can also schedule with our sponsor, Fidere Advisors, in the footer of that website. That's astewardsview.com. From all of us at A Steward's View, we look forward to connecting with you again next week. Until then, please do be wise and decide well.
You've been listening to A Steward's View. To learn more about Fidere Advisors or speak with Aaron, visit fidereadvice.com. That's FIDERE advice.com. To listen to this and other episodes of A Steward's View, visit astewardsview.com. A Steward's View is brought to you by Fidere Advisors, a registered investment advisor offering financial planning and asset aggregation. Asset aggregation systems are designed to align portfolios across accounts into a single, globally optimized investment plan for families it serves. Fidere maintains liquidity of client capital at major custodians and utilizes asset managers that have shown consistent historical performance through excellent risk management. This program is not an offer to transact any securities and does not constitute a financial planning engagement. Information provided has been prepared from sources believed to be reliable, but is not guaranteed and does not represent all available data necessary for making financial decisions and is for informational purposes only. Fidere and its representatives do not offer tax or legal advice through Fidere. Please consult the appropriate advisor. Fidere Advisors LLC is a registered investment advisor. To discuss your situation or to learn more about Fidere, please visit fidereadvice.com. That's FIDERE advice.com.